You see all the ads, the slick marketing, the big promises. But have you ever wondered what's really going on inside a company? Well, the real story, the true story, is told in its financial reports. Today, we're going to break down exactly how to read them. Let's jump in. So, how do you actually see past all that hype? I mean, is a business truly profitable, or is it just surviving? How much debt is it carrying? Is it actually generating any cash? These are the questions that matter, and the answers are all right there. You just have to know where to look. And that place to look is in the financial statements. The best way to think about them is as the official, no-nonsense report card for a business. They are specifically designed to give a fair and true picture of what's happening with the money. Now, to make sure these report cards are actually trustworthy, they're built on two core principles. These principles make sure that everyone is speaking the same financial language. It's all about clear, honest communication. And these two principles are absolutely key. First up is transparency. This just means the company has to represent what actually happened, the good, the bad, and the ugly. No hiding things. Then you have comparability. This means they present their information in the same way year after year and in a way that lets you compare them to other companies. When you put those two together, you get financial reports that are genuinely useful. So to guarantee that fairness and comparability, all financial statements have to follow a fundamental set of rules. You can think of them as the rules of the game. Every single company has to play by them, no exceptions. And here they are. First, going concern. This is basically the assumption that the business isn't going bankrupt anytime soon. Second, the accrual basis. This is a big one. Transactions get recorded when they happen, not necessarily when the cash actually moves. Third, no offsetting. You can't just mash assets and liabilities together to hide the details. And finally, materiality. This means anything important, anything that could influence a decision has to be listed out separately. Okay, with those rules established, we can finally dive into the core financial statements. And the best way to get your head around them is to see them as the answers to the three most important questions you could ever ask about a company. The first, and maybe most obvious question, is all about performance. Over a specific period of time, like a year or a quarter, did this company actually make a profit? The answer to that is in our first major statement. And that is the statement of profit or loss. You know, if you think of a company's financial story as a movie, this statement is like a video of its performance over the whole year. It lists every dollar of income that came in and every dollar of expenses that went out to get to that final bottom line, the profit or the loss. Now, a company has two ways it can show you its expenses. It can list them by nature, which is basically what it bought, things like raw materials or employee salaries. Or it can list them by function, which is why it bought them, like the cost of manufacturing or the cost of sales. But here's the crucial part. No matter which way they do it, that final profit figure at the bottom has to be identical. All right, so we know if the company made a profit. Great, but that's just part of the story. The next huge question is about its overall financial health at one specific moment in time. The answer to that is in the statement of financial position. So if the profit statement was a video, this is a snapshot, a single photograph. It shows exactly what the company owns, what it owes, and what its net worth is on one particular day, like December 31st. This whole thing is built on one simple but powerful accounting equation. Assets must always equal liabilities plus equity. In plain English, that means everything a company owns, its assets, had to be paid for either with borrowed money, which are its liabilities, or with the owner's own money, which is its equity. It always has to balance out. Now, within this statement, you'll see both assets and liabilities split into two categories, current and non-current. And the only difference is time. If it's something that's expected to be used, sold, or paid off within the next 12 months, it's called current. Anything that's going to be around longer than that is non-current. Simple as that. Okay, this is where things can get a little tricky, and it's where a lot of people get confused. Remember that accrual rule? Well, because of it, a company can report a massive profit on paper, but have very little actual cash in the bank. So that leads to the really important question, how do we follow the real money? For that, we turned to the statement of cash flows. This report totally ignores all that accrual accounting stuff and focuses only on the movement of cold, hard cash. It shows you exactly where cash came from and exactly where it went, and it breaks it all down into three main activities. So what are those three activities? First, operating. This is cash from the main day-to-day running of the business. Second, investing. This is cash used to buy or sell long-term things like buildings and equipment. And third, Financing. This is cash that comes from deals with owners and lenders, like issuing new stock or paying back a loan.
So we have our three main statements, right? But they don't just exist in isolation. There are two more components that act as the glue, connecting everything and giving us that crucial context. First, you've got the statement of changes in equity. This is literally the bridge that connects the profit or loss statement to the statement of financial position. It starts with the owner's equity at the beginning of the year, adds in the profit for the year, subtracts any money paid out to owners, and shows you what the equity is at the end of the year. It makes sure everything ties together perfectly.
And finally, we have the notes. Honestly, think of these as the director's commentary on a movie. This is where the company explains the specific accounting rules it followed, breaks down the huge numbers from the main statements into more detail, and gives you all the other essential info that just doesn't fit anywhere else. The good stuff is often in the notes. But the world of accounting doesn't just stand still. The goal is always to improve that clarity and comparability we talked about at the very beginning. And right now, a really big change is on the horizon.
That change is called IFRS 18. It's a brand new global standard that's going to replace the old rules for how financial statements are presented. It officially becomes mandatory on January 1st, 2027, although you might see some companies adopting it even earlier.
So, what's actually changing? Well, for one, IFRS 18 introduces mandatory categories for operating, investing, and financing activities right there in the main income statement. This makes it much harder for companies to get creative with how they define their operating profit. It also brings in much stricter rules for reporting any other performance measures they might want to show off.
And the goal here is pretty simple, right? It all comes back to those core principles. IFRS 18 is designed to improve consistency by making sure profit is defined more clearly. It's meant to enhance transparency by stopping companies from using misleading numbers. And it's going to boost comparability by standardizing how reports are structured across all companies.
So, when you boil it all down, the crucial takeaway is this: it's never about a single number or one statement in isolation. It's about how all 5 of these components, the profit or loss, the financial position, the cash flows, the changes in equity, and the notes, all work together to tell one complete, coherent story.
At the end of the day, these statements are the language of business. They tell incredible stories of success, of struggle, and of brilliant strategy. So now that you know the basics of the language, what story will you uncover?